On Friday, online review site Yelp began trading on the New York Stock Exchange. The company priced its IPO at $15 per share, which is higher than the expected price of $12 to $14. But at this price, Yelp is valued at nearly $900 million. And while the stock soared in its first day of trading, many analysts are skeptical about the company, especially since it is yet to be completely profitable. And there are also concerns over its position in the marketplace in terms of competition. So at this time, we're going to bring in Francis Gaskins, the president of IPODesktop.com, to discuss some of these issues as well as the future of Yelp. It's great to have you again, Francis.
Thank you.
You're very welcome. Let's first of all just talk about the price. $15 a share and a valuation at nearly $900 million. Is this a rational portrayal?
Well, it traded Friday, around $25. So compared to the trading price on Friday, that's rational. I think the question is, should it be priced at $24 to $25, or what does that mean? Well, if you look at the price to sales ratio, which is only works when you're in a slight bubble, it's over twice the price to sales ratio of Groupon, is 60% above the price ratio of Angie's List. The only comparable kind of social networking stock is Jive Software that went public in around December 7th. And that one makes private social networking platforms for enterprises. People didn't really understand what was happening. That came at 12 and traded around 15, and now it's around 24, which is a big jump. Other than that, all these stocks have, all the retail-oriented stocks have hit their highs on the first day and never seen them since then.
Right, I want to get into some of these uncertainties right now. The questions that many people have fall largely around the profitability, or rather lack of profitability from Yelp. So what can you tell us about these concerns?
Right. Yeah, Yelp, I think, is smaller than we expected to see it when it filed in November, December, and it's not as profitable as I said. But the only companies that have been profitable are LinkedIn and Zillow. So there's a little bit of trust me, on a go-forward basis. And I think the big problem with Yelp, however, is the fact they get 50% of the revenue from Google and Google searches. I mean, and Google has their own local advertising business, but if I think back over the IPOs that have come public the last year and a half, there was one that went public in January of 2010 called Demand Media, and they had a deal with Google where Google directed searches to them on eHow. They were kind of brainless type YouTube videos. Well, Demand Media went public at 17 and went to 25. Google turned off that faucet because they can change their algorithms, and they did. The stock is now off 70% from the high at 726. So I don't know whether the people buying the stock, buying Yelp at $25, $24, realize that Google can turn off that half the revenue faucet by changing the algorithms and putting their own searches up there. Google's like a Leviathan, eats everything in its path, and Yelp is in its path. So that may be an early warning sign, but I would be careful about paying $24, $25 for the stock at this price because of that risk.
Right. I want to get into that Google issue in just a minute, but in terms of the competition, there are also questions around that. So what types of red flags have you seen thus far in this area?
Well, the Facebook is a potential competitor. Who knows what they're going to do. Google is an actual competitor. There's another competitor out there with Yelp. Yelp, on the other hand, has a branding. They have 66 million users. There was a vacuum when they started the company. They filled that vacuum. Now they're trying to defend their space and also increase their users, which is what they're doing internationally. They're going to take their proceeds and expand internationally. Yelp is actually just an internet advertising company, and it gets its advertising from small businesses, and they're not totally healthy nowadays. Most of them are restaurants and shopping sites. So I think in this flatlined economy, the customers that Yelp deals with are not experiencing a lot of growth, so that they have to claw and fight for every ad dollar they get.
Right. Well, getting into the Google issue, Yelp has taken a particularly outspoken stance against Google, claiming that it already shows favoritism of its own search products and search results. But Google, as you said, is still Yelp's greatest source of traffic. So can you talk about this situation and the potential dangers that it might pose for Yelp?
Well, yes, Google controls their own algorithms. Whether it's fair or not is not really the issue. The issue is whether they'll do it. And if there's a plate full of money for them to consume by changing their algorithms over time, they'll do it. They'll try to be a little more subtle. But that's, I mean, it's a private enterprise. They can control their own algorithms. There's nothing that says they have to be favorable. They have to be fair to Yelp. There's nothing there that says that.
Right. And just as it was with Facebook's filing, Yelp's SEC filing also brought to light some discrepancies. So what impact will these have on the company?
Well, the people that are buying the stock now don't care. They don't read those things. There were a couple things that were kind of unusual that I didn't really care for. One is that post-IPO, the insiders, well, they did a dual class of stock, so they control about 99% of the stock. That, as I said, that's over the top. That's unnecessary. What do they know that we don't know? I mean, that's just way too much. I mean, even Zuckerberg's going to he'll have 57%. That's over half. They don't need it. The other thing I don't like particularly is in the December quarter, they put about $6 million of stock into a fund, a charitable fund to help small businesses apparently in their area, which is fine. The only thing is they didn't say anything else about that in the filing. So they took 25% of their revenue. It's not a cash charge, but it's a stock charge in the December quarter, and didn't really explain that in the filing. That wasn't particularly good.
Right. Well, every company has its risks and concerns, but from an investor perspective, is Yelp a good investment overall, in your opinion?
Well, it's a filing price of 13. Sure, it was an okay investment at that time. At the IPO price of 15, it's okay. But there are 66 million users trying to go after $107 million of IPO when it did IPO. Mm-hmm. So I think there's just too much demand for the stock. It's retail demand, and people don't run the numbers, and it doesn't deserve to have the same price to sales ratio as Jive, for example, as I said, which is the highest ratio in the social networking stock area.
Right. Well, how much criticism do you expect Yelp to get from here on out?
It'll take a lot of hits from the analysts who run the numbers also. I think Morningstar said that their valuation of Yelp was around $9 a share, but a lot of times they're conservative.
Right. Okay, and just for both short-term and long-term expectations, what do you see?
Well, I think the stock is going to trade down gradually. It'll do a gradual fade, and it's just at some point in time, supply and demand have to equalize. Right now, there's a lot more demand than there is supply, and I think that the gush of retail enthusiasm coming in today will gradually diminish, and then it should go down.
All right, a lot to look forward to in regards to Yelp. Francis, thank you so much for sharing your thoughts with us. We really appreciate it.
Thank you.
You're very welcome. With this WebPro News Report, I'm Abby Johnson.